You are listening to chartingwealth.com for Friday, the 27th of October, 2017. We see that stocks are mixed for the day. The S&P 500 is up 0.12%. The Qs, the Nasdaq 100, down 0.31%. Likewise, TLT is down 0.32%. That is, of course, the 20-year bonds. And what do we see going on with gold? It's down 0.83%. So again, things are looking good for the trades that we have called, and we'll just continue to sort of watch and see what happens as this week slowly comes to an end. I do want to thank all of you who religiously, day after day, work with us, listen, fill out your daily market worksheets every day, fill out your weekly market worksheets once a week, do the practice trades, and learn. For those of you who are just starting with us, or haven't yet found the time that listen to us quite often, we ask you for 10 minutes a day. 10 minutes is all we ask. 10 minutes of greatness. If you will spend that time filling out the daily market worksheet 4 days a week, the weekly market worksheet once a week, for that 10 minutes, you will put yourself on a trajectory of mastering these charts. And my friends, if you can read a stock chart, if you can figure out entry points and exit points, the world is your oyster when it comes to investing. I know we have people that occasionally show up that I'm a value investor. I want to make sure. Well, of course, everybody wants to make sure that what you're putting your money into is worthwhile. But who wants to go in and buy an asset that is going down in value, even though it may be worth 10 times what it is you pay for it? If over the next several years that doesn't materialize, well, you bought too darn high. Wait for it to hit a trough, buy low and sell high, or buy high and sell higher. But again, we try to use common sense. We keep this simple, and those of you who follow us day after day, you see how well it works. We're not a stock calling service. We're an education firm. We want you to practice with us. Once you get good at this, you can combine what we teach you with all your other knowledge, develop your own path, and then start trading with real money when you make up your mind what you want to do with your funds. Let's jump right into the S&P 500. We see that it is continuing to move up slowly but surely. It's ticking that way. We're going into the 9th week of up movement. Now we can see it's bled off a little bit. When we look at the POP, the PPO, the price percent oscillator, the blue line, we see that it's actually gone flat, almost totally flat. So again, we start looking at where the market has peaked this week, just a little bit, about the same as it was last week, just a little bit higher. The derivative oscillator's actually lost some of its energy. And as we delve in a little deeper, we see on the 2-day chart, it is heading toward a crossover going down. The price percent oscillator is actually heading toward the signal line, hasn't crossed yet. Derivative oscillator's been losing energy since it topped out on the 2-day candlestick ending on the 20th of October. Derivative oscillator's been losing that. Popped up to a higher price high on the 2-day candle ending on the 24th. But this latest candle is a red down candle. It's a hammer with a long wick on the bottom, little bitty wick on top, and has closed below the 2-day trend line. Is this trend coming to an end? Well, you could have thought so all the way back around the 22nd through the 26th or so of September, and then it popped up again. So we'll keep an eye on it. Hasn't crossed over going down. So again, let's just wait and see. It's tried to fake us out a couple of times, but it has not done it because we have good charts. Let's look at the 4-hour chart. What do we see there? Of course, it crossed over going down, gave you a warning on that. Those that had gotten in on the weekly vertical crossover when it crossed over going down back on the 24th, and of course it has since hammered down, has recovered somewhat, but still in a confirmed down move on the 4-hour chart, still gaining downward momentum on both price percent oscillator and the derivative oscillator. So again, be careful. We are still in a confirmed up move on the 2-day chart, and a confirmed up move on the weekly chart. So again, if that 4-hour chart reverses and starts going back up, you may have a jumping in point there. So again, keep being ready to do your practice trades. What do we see going on the Qs? Well, we had thought the Qs might. We did not call it because it was just too close to call. Tried to cross over going up on the week ending the 20th of October. We did not call it. Once the new week that we're into started off, it actually pulled away from the red signal line. It is the price percent oscillator, derivative oscillator, also peaked on the week ending the 20th and then crossed over going down. We now have a red spinning top for the Nasdaq 100, means lots of indecision. These, of course, are the tech stocks. What do we see going on that 2-day chart? We see on the 2-day chart getting very close to crossing over, going down very, very close. Big down candle with a big down wick, no up wick on it. We had the two prior 2-day candles. One was a red spinning top ending on the 20th and ending on the 24th. Green spinning top, of course, they both mean indecision. And then the decision went to a down move. It's way since broken the 2-day trend line. We don't have a good trend line yet. We won't start drawing a trend line until we get a crossover going down on that 2-day chart. What do we see going on the 4-hour chart? Continuing to move down ever since it crossed over going down back in the afternoon of Wednesday, the 18th of October. So again, let's just continue to keep an eye on the Qs, see if we have a 2-day crossover going down. It may give us an entry point sometime over the course of the next week. What's going on the 20-year bonds? Remember, we had that weekly vertical crossover going down back on the 29th, Friday the 29th of September. We had a good down week the following week on the 6th. Then things went sideways. And then, of course, over the course of this last week, dropped back off again nicely. Derivative oscillators continue to pick up downward momentum in the price percent oscillator. Those of you who are new, of course, we try to make virtual money when the market's going up or down. That's why we have inverse funds or puts. You all have asked for some training on options, and we will be working on that on the near future. In the near future, we'll keep you posted when some of that training becomes available. Of course, we are well below the 2-day trend line as we start looking at our 2-day chart, well below the weekly trend line. We had that 2-day trend crossover going down on the price percent oscillator back on the 14th. Seen that the 14th of September, we've seen that the derivative oscillators continued to heat up, going down, as has the price percent oscillator on that 2-day chart. What do we see on the 4-hour? Well, of course, the 4-hour chart, since we had that crossover going down back on the 20th, if you had jumped in somewhere in the afternoon on the 20th of October afternoon, the opening was 124.71. We're somewhere around 122.69. So again, a good $2 worth of down movement on that $120 so ETF. So not bad over the course of what, 5 days? So again, looking nice. We'll continue to keep our eye on things. Keep your eye on that 4-hour chart in particular because the derivative oscillator is losing energy. However, the price percent oscillator continuing to trundle down. Are we hitting a bottom? Been about the same bottom spot over the last 2 days. So keep your eye. See what's really going to happen as we keep moving forward on that down play on the 20-year bonds. Now, lastly, we will go to gold on the weekly chart. Gold, of course, crossed over going down back on the 6th. Then, like the bonds, slid sideways for a couple of weeks, giving us some pause for concern, although the weekly chart continued to not cross over going up. Got as close as it got. It was at the end of the week on the 13th, Friday the 13th of October, and then slid sideways, tending down over the next week. Again, a red spinning top means indecision, and of course means indecision tending down. And of course, the following week, this past week, things have rolled over, going down strongly. Price percent oscillators accelerated down, as has the derivative oscillator. Got a big red down candle with a little wick at the bottom, no wick on top. As we tune into the 2-day chart, what do we see? Well, of course, it crossed over going down back on the 20th of September, went down until the 6th, up for 3 2-day candles for a little over a week, and then started rolling back over, going down on the 18th, and has continued to move down, closed below the red signal, the 2-day signal line and the weekly signal line. Derivative oscillators heated up and the price percent oscillator. And as we look at that 4-hour chart, what do we see going on? Of course, jumping in point back on the 18th, and gold has continued to move down. If you would have jumped in the afternoon on the 18th, somewhere around the opening at 122.07, you've seen gold go down almost, well, it's actually gone below even more than $2. The low it's hit was 120.60, $120.22. So again, about $2 of price depreciation. Of course, if you're in an inverse trend, you're in an inverse ETF, or in a put, nice appreciation over the course of just about 6 days. Folks, that's where we are as we continue to track these markets and jump into trends. We are trend followers. We are not forecasters. Please always remember that. You want to find established trends as we do with the weekly and the 2-day charts, and then use that 4-hour chart as your trigger to jump in at the right time, and also help you make the smart move on jumping out. It is not complicated. It does take practice, and you have to practice it to master it. And if you don't practice with us every day, my friends, I hope you enjoy the sound of my voice, because that's about the only benefit you're getting. Please, I urge you, it doesn't take much more. You can listen to us on the way home, and then when you get home, play it again, and then fill out your daily market worksheets. 10 minutes. 10 minutes. That's all it takes. 10 minutes a day, but you got to do it every day. And it stacks up, that knowledge, that energy, that enthusiasm that you keep going, and your skill set. It will build and build and build and build, and you will be amazed, but it will not happen effectively until you start filling out the daily market worksheets, the weekly market worksheet, and do the practice trades and fill out that trade sheet. I emphasize it so often. Those of you who do it tell me of the magic it performs. And folks, you got to do it. Just a little bit of time. You will be singing the praises very, very shortly if you will just do it through thick and thin. Keep practicing. We are in the fat time of year. We're in the fall-winter trading zone, the best time of year to be in the market. We've come out of the crappiest time of the year, the summertime trading zone. Still did well during that, but it's the most awful time. Sell in May and go away. Live to trade another day. You hear that. We said that all through the summer. But when October 1 hits, it's the time to be in the market. All the money comes back in, the volume increases, and the trends seem to be so much more easy to find and recognize and make good virtual dollars on. God bless, my friends. Let us hear from you. CW@chartingwealth.com. And of course, if you're not already a subscriber to the Daily Market Review, go do that. That's how you get the Daily Market Worksheet, the Weekly Market Worksheet. That's how you get the Trade Worksheet. That's how you get all the early trainings that we put out. Take care. From the whole team here at Charting Wealth World Headquarters.